Today, breaking down how accredited investors can diversify into real estate without owning anything directly. No tenants, no repairs, just predictable cash flow backed by real estate. So, investors want real estate participation, but without ownership. There's time and stress associated with directly owning a property. Things break, and in fact, everything breaks, and almost always at an inopportune time. You've got alternatives to the stock markets, there's no doubt, but you can find yourself having predictable income without direct ownership. So there's a handful of ways to diversify into real estate without buying properties directly. The one of it being real estate debt funds. You come together in a co-lending scenario where it's backed by real estate. You're lending just like a bank to operators out there, typically fixing and flipping property. They're remodeling that, they're repositioning it, they're selling the property. Or they're going to put a tenant in there, they're going to refinance it, and they're going to keep that property for a long time. Another way is a private REIT. Those can be both be equity or debt, and you've got steady cash flowing properties that are in there. Typically, you end up with a bunch of diversification, which is often what accredited investors are seeking, and you have some different redemption options. On the debt side of things, it's typically a little faster. On the equity side of things, a little slower. But they can range anywhere from 6 months to 2 years. It's definitely more liquid than true private syndication. And the next one I've got is a public REIT. So you want to talk about liquidity? Public REIT is as liquid as it gets because it's traded as a stock and you can have liquidity today. A lot of pros and cons there. Pros are you both have, again, debt and equity. A lot of cash flow can be had there from dividends. The downside is it's highly tied to the stock market, very highly correlated to the stock market. So does really well when that thing's running up and can get punished when the thing runs down. Syndications. Private syndications are a really good way to get access to real estate and without direct ownership. Somebody else is going to find the property, manage the property, handle everything. And as long as liquidity is not a big factor for you, that can be really good because some of these can last anywhere from 2 years, which is pretty quick, all the way up to 7 or 10 years. And the last one is private notes. Private notes look like a debt fund kind of, but they're private in the sense of you're doing a lot more work. You're going to either underwrite a private note to create that, or you're going to buy a note that somebody else has created. So the benefit there is it's hands-on if that's what you're looking for, and you can end up with a higher rate of return than a debt fund, for example, because you're taking on more risk and you're taking on more work. Debt funds actually often beat equity. And why is that? Well, debt funds are paid first, right? Because we're in a first mortgage lien position, it's got to be paid first. Lower volatility, much like a bank, but you can end up with equity type returns with anywhere from 8 to 12% returns. Stronger downside protection. Then there's a Midwest advantage. The Midwest advantage, you've got stable markets in the Midwest, consistent demand, and predictable valuations. So if you want predictable income backed by returns, well, you can look at Midwest real estate in a debt fund scenario. If you want to learn more, I dropped a link below in the description.